Good day, everyone. Thanks for joining. We're going to give folks maybe another 45, 50 seconds to get signed in, and then we'll start. Good day, everyone, and welcome to this RMA Risk Readiness Briefing Special Coverage Series. My name is Stephen Martin, and I lead the Business Solutions Department at the Risk Management Association. And RMA is proud to make this presentation complimentary to our members. And if you're not a member, I urge you to go over to rmahq.org to check out all of the benefits and things that we have to offer. Today's webinar is our latest installment of the Credit Trends in Commercial Lending. It's a part of our risk analysis service, and it will be presented today by Tom Cronin and Jeremy Charlson from AFS, our partner on this service. During the presentation, if you have a question, and I hope you really do have questions, that makes this really interactive, please submit them using the Q&A feature, not the chat feature. That'll be found on the bottom of your Zoom screen. We will address all of the questions that we have time for at the end of the presentation. So before we get started with things, we'd like to take a quick poll. And this is unrelated to today's topic, but it's related to our industry. And Denise, if you don't mind popping the poll up. So bank regulators have suggested that banks stop using or stop entering into new loan contracts with US dollar LIBOR as a reference rate as soon as possible, but no later than December 31st, 2021. Given this directive, what base rate is your organization considering as an alternative to LIBOR? And I see some numbers coming in already. Thank you for that. And if your bank isn't in that business, there's an option for you at the very bottom. We'll give that maybe another 20 seconds or so for people to answer. All right, about 5 more seconds or so. Okay, I think in the interest of just having some fun with this, we'll share the results right now, just so you can see it, but I'm sure that we will come back to this topic over the coming months. And it looks like SOFR is by far the leading alternative. Great. Okay, without further ado, I'd like to turn it over to Tom.
So thanks, Stephen, and welcome to everyone joining us today. Now, after we reviewed the January 2021 data, many of you that have been on that webcast completed a survey and made a number of suggestions as to how we might improve this webcast. And today, you'll see that we've enacted many of these suggestions, the first of which was sending out the PowerPoint this morning, so you have time to review it prior to the webcast. Now, another suggestion was that I slow down. So I'm going to try my best and be a bit more deliberate and spend some extra time explaining what you're seeing, but I'm not going to guarantee anything. Our data source is the Risk Analysis Service, or as we call it, RAS. We gather performance data from banks every month, process and verify about $1 trillion in exposure and over 700,000 loans, and return that data to each bank member via a workstation. With that workstation, member banks can then compare their data and results to the select peer groups by segments such as collateral, industry, and geography. And RAS is the source of everything you'll see today. So we're going to examine the C&I portfolio in the next pages. And just by way of quick definition, C&I loans are business purpose loans made to companies with annual sales north of $1 million. These loans are manually underwritten and also manually risk rated. And loans secured by owner occupied properties are in the C&I portfolio. So let's start with a historical and current examination of loan performance. On this chart, there are 4 lines, one for each measure of performance, as follows. The red is the non-accrual line. The dark blue is past dues 30 to 59 days. The yellow is past dues 60 to 89 days. And the green is past dues 90 plus days. And if you start on the left and go to the right, for all the measures, you see the spikes caused by the recession starting in 2008. Then we see another jump in non-accruals in 2016. This was due to the energy crisis. And we saw a third spike in 2020 for 30 to 59 days delinquent and the non-accruals as well. In fact, the short-term delinquencies hit a service level high of 1.33% in April of 2020. But since that time, we have dropped down to just 0.39% for February 2021. Now, non-accruals started to climb ever so slightly in early 2019, and eventually moving over 1% by November of 2020, before sliding back the last 3 months. And non-accrual level now sits at 0.93%. And on the next few slides, we're going to take a deeper look at both the short-term delinquencies and the non-accruals. As I mentioned earlier, RAS is the only credit benchmarking database with data back to 2003, and it is also the only database to be collecting data on a monthly basis, and that's a banking credit database. When we began collecting data on a monthly basis last year, we noticed a very interesting trend in the rise and fall of short-term delinquencies. And on this chart, we're showing this trend in short-term delinquencies. And again, this is 30 to 59 days past due since March 2020. And you can see that each of the 4 peaks occurs on what we're calling an intra-quarter month. So April, the 1.33, July, 110, October, 103, and then again, January, 0.64. And each subsequent low point is a quarter end month. So June at 0.7, September and December. And I mentioned last month that we had talked about this with Brad Cunningham of Commerce Bank. And Brad had suggested that perhaps RMs were more active in the collection efforts at quarter ends. And the decline in delinquencies for February 2021 further supports this hypothesis. And we're going to see later on something else very interesting in looking at volume intra-quarter versus at the end of the quarter. So again, recognizing that delinquencies are down, we thought we'd just take a real quick look at what's happening for the 30 to 59 days past due for each of the 2-digit NAICS sector. And there are 3 sectors that are above 1%. Those are 55, management of companies at 1.61, 52, finance and insurance at 1.16, and 22, utilities at 1.14. And you can see that the dotted line is the average, but also note that 17 of these 24 sectors are below 0.5%. And this is a long way down from where we were when the pandemic first hit back in April. If you remember, we were up to 1.3%. So quite a recovery. Now we're looking at the percentage of loans that are past due, again, 30 to 59 days past due by each region. And as a quick definition, in RAS for the C&I portfolio, we use the location of the borrower to identify the state, not where the bank is located. So every region, with the exception of the Northeast, is below 0.5%. And the Northeast is 4 times as high as the second highest region. And within the Northeast, we're seeing elevated past dues for utilities, trade contractors, financial investments, and holding companies. And if you quickly remember, several of these were what we just mentioned on the previous page. Now let's move on to non-accruals. So we're basically a year into the COVID-19 pandemic as we look at the February 21st data here on March 25th. Matter of fact, it was March 17th was my last day, full day in the office, March 17th, 2020. So now I'm just a little over a year of having working at home. And I assume that's the same for a lot of people. And over that year, many businesses were forced to shut down or greatly reduce capacity. Offices across the country remain empty, as do many hotels and bars, but some businesses prospered, and the K-shaped recovery that we've heard about has become evident, as we can see here. On this chart, in the columns, we have the percent non-accruing for each 2-digit NAICS code as of March 31st, 2020, which we're labeling as the start of the pandemic. The red line then charts the percent non-accruing for each 2-digit NAICS code as of February 28th, 2021. And the gap between the two, so the gap between the red line and the blue bar, represents the impact or lack of impact of the COVID-19 measures. And the industry with the largest gap, the industry that has been most impacted by this past year, by the pandemic, has been 21 mining, oil, and gas. The non-accrual rate for mining, oil, and gas has more than doubled since March of 2020. Other industries that have been negatively impacted include 71, arts, entertainment, and recreation, as that increased over 200 basis points. And 55, management of companies, also jumped almost 200 basis points. And we saw a significant increase for 72, food and accommodation, or accommodation and food. The most improved sector, almost 100 basis points, is 11, agriculture. And a number of industries, such as 22 utilities, 42 wholesale, 49 transportation, showed very little change or impact from the virus shutdowns. So this is a chart that I often refer to as our so what chart. And I'll explain what I mean by that in a second. It enables you to see industry sectors with high non-accrual levels, but also see how big, and by big, I mean the percent of the total outstandings of the entire RAS portfolio, how big those sectors are in the overall picture. So if you have an industry with a high non-accrual, but not much in the outstandings, then it's like, well, so what? Does it really matter? And each RAS bank can create this chart using the RAS workstation. So they can see if their worst performers are a significant part of their loan book. So on this chart, you do not want to see any sectors in the upper right quadrant, which would mean high non-accruals and a large amount of outstandings. And you can see that nobody is up there. No industry is up there. So we'll start with the positives. And it was a further example of the K-shaped recovery. So if you go from the upper right to the lower right, and then work your way back to the left, you see 52 finance and insurance, 62 health, and 44 retail. These sectors are the 3 largest in RAS, but have some of the lowest non-accrual rates. In fact, if you keep going to the left, you'll see 3 more of the largest sectors. They're not named here, but you can see the dots there. And all of these are under 1%. Together, these 6 sectors represent 51% of the outstandings in RAS, and every sector is below 0.7%, which is well below the average. And the average is 0.93. Let's continue moving to the left, but up a little bit. And here we have labeled the sectors with the highest non-accrual percentage. There are 5 sectors with a non-accrual percentage greater than 2%, but only 72 accommodation is in the top 10 in terms of balances. 3 of the others, 71 arts, 55 management of companies, and 45 retail, are in the bottom 5 in terms of balances. So your exposure, overall exposure to bad sectors is very limited. So one final look at loan performance. This time we're showing non-accruals for each region. Loans in the Southwest are performing the worst, primarily due to the mining, oil, and gas located in that region, followed by loans in the Northeast and the Eastern Midwest. And you'll recall from the delinquency chart that the Northeast had the highest delinquency levels. So here they were highest in delinquencies and they're second highest in non-accruals. So obviously there's still some issues in the Northeast. And on the other hand, the Western Midwest at 0.26 repeats as the lowest region, both for non-accruals and for delinquencies. Pardon me. Now we'll move on to credit quality and risk ratings. And when a bank joins RAS, we map their native risk ratings into the RMA 10-point scale. On that scale, 1 through 6, loans rated 1 through 6 are pass grades. 7 is a special mention, 8 is substandard, 9 is doubtful, and 10 is a loss. And combined, these last 4 are also referred to as criticized, and that's what we're showing here. On this chart, we're showing the historical trend in percent criticized with detail in each column for special mention, the blue, substandard, the yellow, doubtful, the green, and loss, where you can see it in the red. And after topping out at 21.23% in September of 2009, the overall percent criticized steadily improved for the next 6 years. We saw a slight rise in 2016, 2017 with the energy crisis before trending down once more to a low of 5.5% at the end of 2018. So that's from 21.23 at 2009 to 5.5% at 2018. And the criticized rate floated in the mid 5% range until April of 2020. And from April of 2020 to September of 2020, the overall rate climbed about 275 basis points to 859 as banks anticipated significant loan issues due to COVID. Since September, similar to what we have experienced with the performance stats, the percent criticized has moderated. And for February 2021, that now stands at 7.9%. And this is the 5th month in a row that the percent criticized has declined. And this improvement, along with what we are seeing with the delinquency and non-accruals, improvements there also, would appear to signify that a soft landing is at hand. This chart originated with Zions Bank and is one of the benefits of being a RAS member, and that you can share portfolio management approaches and techniques. I'll take a minute to explain what Zions did here and what they were attempting to discover. So we're looking at the percent non-accruing in the red, and then the percent special mention in the yellow, and the classifieds in the green. And the classifieds, again, include loans rated substandard, doubtful, and loss. And we're looking at this for each NAICS sector for February 2021. And by combining these 3 measures, you get a look at not only the current problems, which are the non-accruals, again in the red, but also potential problems, the special mention and classified, and therefore an overall look for each sector. Now, for me, more than any other chart will show today, these results emphasize what economists have been referring to as the K-shaped recovery that we're experiencing. there are 6 sectors that are above 10% on this chart. Leading the way, or said another way, the industry projected to have the most problems is 21, mining, oil, and gas at 23.3%. That's followed in order of severity by these sectors and subsectors. 71, arts, entertainment, and recreation, and the subsector there is fitness companies, gyms. 72, accommodation and food. The subsector there is restaurants. 48, transportation, the air and cruise lines. 45, retail, and I'll have a little more information on that on the next slide. And then 11, agriculture, cattle and vegetable oil. Now, about half of the sectors show very little current or potential problems with a combined rate in the 5% range. But you can easily see the 6 sectors that are above 10%. So given what we just saw, I want to take a deeper look at one of the highly impact sectors and one that's talked about quite a bit. And here we're taking a closer look at 45 retail. And there are 4 subsectors or 3-digit NAICS within the 45 industry code. So currently, the worst subsector is 454 non-store retailers, way over on the right-hand side. And I say currently because that's the non-accrual. I'm looking at the non-accrual, the red. Non-store retailers, another term for those is direct sellers. An example of that would be lunch wagons, which if you think about it, with offices closed, not much is happening with lunch wagons. The non-accruals for these non-stores are at 5.25. But the potential problems are forecasted to be greater for the other 3 subsectors, with general merchandise stores the highest with an overall rate of 21.8%. And general merchandise would be your mall anchors, which have been closing at a rapid pace even before COVID. So you can see here that it's a combination of problems, current problems with non-store, but then projected problems with the mall stores, sporting goods, bookstores are in here, and other types of stores. So we wanted to wrap up our look at C&I with a couple of growth-focused charts. For this pie chart, we compared for each bank loan outstandings as of February 21st versus January 21st, calculated the percent change, and placed each bank into one of the 3 slices. Increase would be changes greater than 1%, decrease, changes less than a negative 1%, and flat, anything in between. And as you can see by the large yellow slice, balances are mostly flat. There's not much growth, but not a lot of runoff either. And please note, these results do not cover PPP loans. We're going to talk about those in a little bit. So overall, even though balances were flat, we thought it might be interesting to see if there were any significant movements, either up or down, at the individual industry sector levels. So let's start with the declines shown in the red. The most obvious is a 6.9% drop for 45 transportation. And if you remember what we saw on the Zions chart, the top 6 sectors there were oil, ag, oil and gas, 45 retail, 48 transportation, 71 arts, and 72 accommodation. And all of those saw drops in balances except 45 retail. And 45 retail was the second fastest growing industry behind utilities. And I always find it interesting, and I wonder why when we see this growth, not only a little bit of growth, but substantial growth in an industry that it appears everyone acknowledges is either in trouble or will be in trouble. I'm always perplexed as to why you see this happening. So I mentioned in the preceding pie chart that did not include PPP loans. So the next 2 charts, we're going to look at PPP loans just for the RAS banks. This chart shows the actual outstandings for PPP loans. They topped out at 56 billion at the end of June and had slowly repaid over the next few months to the end of 2020 and into January of 2021, falling to $46.1 billion. But we saw a jump of almost $4 billion this month, February, as the program was reinvigorated. And there's little doubt that the combination of the government stimulus programs, PPP being one, and bank deferrals have helped minimize the impact of the measures put in place to control the virus for most industries, as we pointed out on our previous charts. And one last chart for C&I and PPP. Here's the PPP loan distribution by NAICS two-digit code as of February 2021. And 54% of the PPP balances are in 5 sectors going left to right. 23 construction, a little over 6 billion. 54 professional, 6.5 billion. Healthcare, 62 healthcare at 6 billion. 72 accommodation, 5 billion, and 81 other services was at 3 billion. In some industries, such as utilities, 49 transportation, 55 management, and 92 public administration, received very little PPP money. And I also wanted to mention that of the 6 most distressed industries noted on the Zions-based chart, only 72 accommodation received a substantial amount of PPP loans. Those other industries received no help in terms of government stimulus from the PPP loans. Now we're going to move on to the CRE results. And again, a quick definition before we look at the charts. CRE loans are made where the primary repayment of the loan comes from the rental or leasing of the property. And these are often referred to as investor owned. Now, over the last part of 2020 and into early 2021, while the problems with C&I loans cooled, delinquencies down and non-accruals down, the CRE loans continued to deteriorate. But for February 2021, we're seeing a change in direction. When we started the CRE portfolio, I'm going to go back a little bit, but I'll get to the change. When we started the CRE portfolio in 2010, the non-accruing rate was 9.3%. We reached a service low of 0.28% in March of 2020. So basically no non-accruals. And it stayed below 0.3 through May of 2020. Then June saw a huge jump, and almost every subsequent month saw increases until we reached 1.28% last month. But for February 2020, the percent non-accruing dropped to 1.2%. And all 3 delinquency measures shown here are also down month over month. So that brings up a question. Have we peaked? Has the CRE portfolio peaked just like we seem to have hit with C&I? Or is this just a temporary pause? So I'm not going to spend a lot of time on this chart as we just covered the trend in non-accruals in the previous page, but I thought we'd split out at least the last 12 months from all time charts so you can get a clearer picture of how COVID impacted CRE and what's happening now. As I mentioned, there was very little impact until the summer. And then the occupancy problems and cash flow issues hit with steep increases in the percent non-accruing as we entered the colder months. Now for March 2020, this will be the first chart I create to see if February's decrease was the beginning of a downward trend or just a pause like we saw in September of 2020. It'll be interesting, as we were talking earlier, a lot of people now are getting vaccines, and whether people will start going back to hotels and bars and restaurants, and this number will continue to decline. We're again looking at non-accruals, this time by the 8 major property types. And my definition of major is the property types with the most outstanding balances as of February 28th, 2021. And just in case anyone is wondering, Mixed use tends to be the combo apartment retail buildings or apartment office retail buildings that have been very popular recently. And there's no secret or no surprise here. Lodging has been impacted the most since June of last year. At the beginning of June, the percent non-accruing for lodging was 0.13%. It topped out for now at 8.84% last month and now sits at 8.8%. And perhaps just as interesting is the non-accrual rate for the other 7. We saw very little movement in these until December, when rates for healthcare jumped 100 basis points and industrial properties more than doubled. Then in January, the percent non-accruing for retail increased by almost a factor of 5, and we also saw a jump for mixed use. But throughout 2020 and into early 2021, multifamily, residential, and office have been largely unaffected and remains the lowest of the 8. And the office number continues to surprise me. But again, another example of the K-shaped recovery. So this is the trend in percent criticized for CRE, and we built this the same way we do the percent criticized for C&I. Each segment, the special mention, substandard, doubtful, and loss, of the overall percent criticized has a space within each column for every period since RAS CRE started. And as you'd expect, this chart mirrors the performance chart. The percent criticized reached a service low of 2.11% in March of 2020, but climbed to 8.94% over the next 4 months. Since then, it's moderated somewhat and now sits at 8.23%. And I would mention that most of the moderation has been in the special mention category. It was 6.25 in July. It's now 4.4. Substandard and doubtful balances, however, have increased. Substandard was at 1.35 in March. It's now at 3.57. And this is a little different from what we're seeing with C&I. In C&I, it appears we have peaked for all of these ratings, special mention, substandard, etc., and the loans are beginning to get better. But for CRE, it appears the special mentions have been resolved, some favorably, but a large percentage are being moved to less favorable outlooks. And this unfavorable movement makes me wonder if the C&I troubles have peaked or just paused, as we talked about earlier. And I could spend almost an hour more talking about this, but let's move on. Once again, we're looking to the Zions inspired chart. And same as what we created for C&I, for each of the 8 major property types, you have these 3 measures. Non-accrual in the red, which illustrates current problems. Percent special mention and percent classified, the yellow and green, which illustrate potential problems. And it's very obvious that lodging has the most current and possible future problems. In fact, the non-accruing rate for lodging by itself is higher than the combined non-accrual criticized level for any other property type. For example, lodging non-accrual is 8.8%. The combined rate for retail is only 7.4%. And so if you assume that the almost 18% special mention, or the yellow, for lodging loans will eventually be okay, you still have over 18% labeled as substandard. Combine that with the 8% non-accrual, you're at 26% trouble loans. So that's not a very rosy picture for hotels. Now, I'd like to finish today with a couple of looks at CRE growth. This is another repeat from C&I. We take the change in balances, February versus January, and slot each bank into one of 3 pie slices. Again, the increase, the green, is greater than 1%. The decrease, the red, less than 1%. And the flat, anything in between. And it's almost identical to what we saw for C&I, with the large percentage in the yellow or flat. And the majority of banks had a month-to-month change that was flat. And the growth that we saw throughout much of 2020 for CRE has abated. So instead of changes in balances, with this chart, we've selected loans that were originated in each month since March 2020. And we're comparing each month's origination versus what was originated in March. So if you take the first data point on the left, which is April 2020 of about minus 80%, this is saying that April originations were 80% below March originations. So if we originated $100 in March, we originated $20 in April, and then $40 in May, and so forth. And I think there's two things to take away from this. First of all, you can see that post-pandemic declaration, the new loan volume fell dramatically and still has not gotten back to pre-pandemic levels. In fact, in February, we're at about 70%, down 70% from where we were a year ago. And then secondly, if you think back to the delinquency charts, there we saw the lowest percent past dues at quarter ends. Now, if you look at the best growth periods here, even though they're still below March, still negative, the best growth periods are June, September, and December. These are all quarter end and show increased volumes. So it looks like a lot of collection and lending activity is occurring at the end of each quarter. And I'll be positive and say that the intra-quarter months must be dominated by prospecting. Now, another look at new loans. Again, that's loans here that were originated in the given month, February, January, etc. Here we've plotted the recent trend in purpose, which is either financing construction projects or making long-term loans for existing leased up properties. And throughout 2020, permanent financing was more prevalent as many construction projects were either halted or postponed due to the restrictions put in place as a result of COVID-19. But now we're seeing a surge in construction projects, and the mix is now about 50-50. And one last look at growth. Here we're looking at loans that were originated in February of 2020. We take the new dollars for each of the top 8 and divide that by the total new dollars for those 8. So this is just within that 8 sector growth period. So if you look at the blue pie slice, the 32% label means that 32% of the new loans were for residential properties. The next highest in the green was office at 24%, followed by retail, still strong at 13%. And finally, after a number of months of increases above what you'd expect, given their non-accrual level, lodging in the red had only 1% of the new loans. So that's it for February 2021. And as I look at this summary and all the performance measures declining or improving, you can easily conclude that overall, the impact of COVID-19 was minimal, and we might be beyond it. And again, please note I'm saying overall. As we know, anyone who owns a hotel, a restaurant, or a store in a mall would wholeheartedly disagree with that statement. So Stephen, I'll pass it back to you.
Great, Tom. Thanks for outlining all of that. Terrific job. Yeah, great. Another reminder on our questions. So you've got a Q&A button on the bottom of your screen, and there's hundreds of us on today's session. So I encourage you to get your questions in now, and we'll get to them. And before we get to the questions, there are a couple that are already lined up. Tom's got a slide here that I think is worth us just pausing for a little bit of a celebration. We are very happy to see within the next month or two the next version of the risk analysis service that will be available to the market. And you can see one major improvement that we're making is its visualization. And there's all sorts of things that we can do for the portable devices as well as the desktop devices and devices. And that's, I think, only going to increase all of the subscribers' benefits from the risk analysis service. And the second thing that's not on the page, but it's worth mentioning, is we are working hard to make this service accessible to every bank that's on this call and throughout the country. So it's easy. It will be easier than ever before to become part of this service. So at the end, you'll see some contact details, but I think you know how to get a hold of us at AFS and at the RMA, and I encourage you to do so if you have an inkling of interest. Okay, let's get to the questions. One from Stephen, thank you. Number 49, oh, this is a C&I question, Tom. Number 49, transportation seems to be hit hard with all the shutdowns and switches to online shopping and shipping. What markets are the shortfalls occurring?
Steve, if I remember correctly, this is the airlines and cruise lines. I'm trying to check my notes just to make sure that's true statement. But I think those are the two within transportation that are being hit hard.
I remember you mentioning airlines specifically during the presentation.
I know I had it in here. Rather than waste, I'll find that and send that out. Yep.
Here's a CRE question, again from Steve. Non-accruing, do bank-initiated waivers of principal and interest payments for a set period qualify as non-accrual?
The best of my knowledge, the answer to that is no.
Yeah, I would concur with that. Great. And then Aaron, hey, thanks for the shout out, Aaron. And you have a question as well. Could you please send the PowerPoint slides? Oh yeah, they were sent out to everyone, but Aaron, I'll make sure that we, after this call, I'll send out an email to you. Sorry about that. We, as Tom had mentioned at the top of the hour, we tried something different this time in getting them out to everybody in advance. Next one is from Amy. Any thoughts on what is driving the increase in non-accrual trends in healthcare and industrial CRE?
So in healthcare, from what we can tell, it's with nursing homes, primarily because of the when the virus hit them, a lot of their people were either pulled out or died. So it's there's a cash flow issue there. Industrial, it's related not so much to warehouses as it is to self-storage facilities, which is sort of strange. But apparently what's happening is a lot of people that lost their jobs had self-storage and couldn't pay for those. And so the roll down that way.
Gotcha. Okay, next question is from Debbie. How many banks are in the risk analysis service for the data, the data, Tom?
Data. So at the current time, there are 15 banks in the service.
Great, thank you. Okay, and Tariq, we'll make sure that you also get a copy of the deck. My apologies for that not happening. And Randy, out to you as well, and Ken. Denise, if we can make sure that we've captured these comments, because I don't want to lose them. I'm not writing down everyone's name now, and I want to make sure we get it. And that actually takes us to the end of the questions. One person came in anonymously saying that they didn't receive the slides. I'll just need your first and last name, please, if you don't mind submitting that question, and again with your first and last name. All right. Also, make sure you're checking your filters. We send it out through our automated service, and I worry sometimes that might get trapped by your filters on your end, people. Okay, I'm stalling just for another second or two, in case someone's got a last-minute question.
Stephen, there's one in here from another anonymous. Do you see that one?
Oh, I see it. Yep.
Yeah.
So given the FFIEC guidance that financial institutions are not required to regrade their COVID modified loans, how can you predict we're looking at what you would call a soft landing, Tom?
Right.
We don't actually know the delinquency or the extent of the criticized loans.
So that statement, your last sentence is true. We don't know the extent, but what we have found in talking to our banks is that most of the deferrals and forbearances have been lifted, or people are back to regular payment period. So although there's probably still some loans out there that will go bad, to the best that we can determine, most of the industries are where you're going to see them. We're not anticipating you're going to see jumps in many industries, with the exception of, if you remember the slide that I've mentioned several times from Zion's, those 6 industries that have been hit the hardest. We think the final numbers for those are still to be determined, but from the best that we can look at, all the other 18, if I'm doing my math right, all the other 18 industries right now appear to have weathered the storm. Of course, this is going to all depend on the success of the virus, the vaccine, and how that handles the virus. If it goes according to plan, we'll be back in offices and back at work and traveling again. I think, Stephen, you had mentioned that the TSA saw numbers that are back up.
Yep.
So it looks like, for 18 of the 24 industries, we've seen the worst.
Yeah, I think just a little color from my angle on that, Tom. You'd mentioned that the TSA daily and weekly numbers, when we were at our prime, let's say back in 2019, we would see daily of between 1.5 million and 2.1 million travelers per day. And, we went down to the 200,000 mark for a lot of last year. So that's a huge decrease. And now last week it was back up over 1 million per day. So it's certainly not back to normal, but what that means is that people do feel comfortable to travel, and presumably they'll start using hotels and maybe even restaurants and so forth. So that part of it is there. And then I think on top of, you'd mentioned this, Tom, but the second round of PPP, the American Recovery Act, will be starting to take hold. And the vaccines, every day there's another 2 million vaccines going into people's arms. And so, one can't help but think that we may have averted something very bad, and we are headed for this soft landing, as you'd mentioned. Okay. All right, I'm just scanning through here. There's one from Anonymous. What about the extent of sublease office space? Isn't that going to impact the office vacancy?
So this is interesting, because we had some questions about this last webcast. And so I actually took a little deeper look into this, because we had some different opinions. So what's going to go on with office spaces? And again, as the vaccines roll out, you're going to have 2 competing, if you would, factors at play. One's the term I've heard is called RTO, return to office. And we expect that's going to be something less than 100%. We were talking just before this, earlier this week, Ford Motor Company announced that I think it was 30,000 people, 30,000 employees of Ford no longer have to come into the office, regardless of when the virus ends. So that's 30,000 people that will not be in the office. So their RTO is going to be something less than 100%. On the other hand, you have a measure of square feet per employee that's expected to go up. So the question is going to be in a building is, what's your RTO versus what's your new employee per square foot? And so as those 2 measures bang into each other, you're going to find out what your office vacancy is going to be. And the subleases, it's interesting you mentioned this, because I was reading articles on a lot of firms in New York City and San Francisco have, hundreds of thousands of office space up for sublease. And I can't remember some of the names of the companies, but these are relatively large companies, such as WeWork is one of them, S&P Global, First Republic Bank in New York. So, a lot of big companies are, trying to sublease their office properties. If they can't do that, their option is going to be to turn back the keys. And then you'll see office vacancy go up as well. But as Stephen and I have talked about it's not going to be, the problems in office are not going to surface in a like in a day or overnight. This is going to be a long, rather drawn out period as these leases, because leases are long term, as these leases get to expire and people decide not to come back, or I don't need 10 floors in a building, I need 2. So we think it's going to be a long period of problems.
Yeah, it's probably worth kind of looking at several metrics, like you were saying, occupancy rates, but also price per square foot. And these announcements, these large scale announcements, I think help set the tone for what other companies are going to be doing and tolerating. Before the webinar, you were mentioning Target Corporation also making some changes in their headquarters decisioning, and that's clear to be influential to other firms. Okay, Tariq asks a good question. Any projections available to which industry may rebound faster?
So if I think of the 6 that we've pointed out, to me, the one that's going to, well, we've already talked a little bit about one that's coming back, and that's airlines. It appears people are starting to travel. The other one that I think will come back probably in the fall timeframe, again, dependent upon the vaccine, are restaurants. I noticed in my state of Pennsylvania, the governor has relaxed the standards as to what % you can occupy indoor. And I think that as more and more people get the vaccine, that'll go up and they should be able to come back faster. Hotels, I'm not so sure about. I've seen some projections on those saying 2022, 2023 at the earliest, that it's going to take a while for those to come back.
Okay, Dot asks, do you think that PPP loans and the other SBA subsidies are keeping delinquencies down?
So I would answer yes to that I think that they did and they are. And they've, if you think about it, I can't remember the exact figures, trillions of dollars was pumped into the economy to keep a lot of these businesses going. And it definitely had an impact in keeping delinquencies down.
Yep. Okay, we had a submission from Anonymous for the CRE slides under CRE non-accrual trending property type. Should the year on the lower left of the chart be for the year 2020 and not 2021?
I'll take a look. I see there's another one right below that. I'll take a look at that.
Okay, good eyes, people, if that's the case. Yeah, the other question from Clay. Thank you for that, Clay. Another anonymous question coming in. What impact will these decreases in rental income have on property values?
So it's going to have a negative impact on property values, particularly certain property values like things that are in malls, a good example, hotels. Those are, you're not going to see, and we've sort of been seeing this with malls for a while. I don't think COVID pushed malls. Malls were already heading south. I think COVID just gave them an extra shove. And I think the value of there was some CMBS statistics out for malls that are defaulting and they're losing 75% of their value. So I think certain properties are going to see tremendous decreases in property values.
Good. All right. Well, does anybody on the call have, we're almost at the end here, folks, but maybe open it up just for one last burning question. Dave asks, can you comment on trends on cap rates?
So Deb, this was another suggestion people had was that I not do this on the call, that I answer the questions, but I did not look at cap rates this month. So if you could send me an email, I will give you the answers on what we're seeing with cap rates. I did not research that month. I did not research that this month, and I apologize for not having that information.
Yep. So with that, Tom, maybe you could advance to the slide that has your email address on. I'm sure people already have you indexed, but in case they don't. All right, now's your chance to grab that. Tom Cronin, lower right there. And no other questions, Tom, coming in. So thank you as always, Tom. And Jeremy's behind the scenes doing a lot of the legwork as well, and doesn't get the spotlight of the microphone, but deserves a lot of the credit. So thank you both, Tom and Jeremy, for today. And also thank you for everybody taking time out of your day to come and talk about this with us. We know you have a lot of different choices for your information, and we appreciate you coming back. And we also welcome those of you who are new to it. So our next session, be on the lookout for that, will be in about a month. You can register on our website. And you could also consider joining us for another webinar, Pandemic Trends and Insights, taking place next Wednesday. That's March 31st at 1 p.m. Eastern. So that's the end of our webinar today. I encourage you to take a moment at the conclusion to complete our post-webinar survey. That's how we can get better at this. And we appreciate you taking the time for that. Thanks and have a nice day.